Okay, so I think time is up. And hi everyone. So I think everyone is up. All right. So I introduce myself. So my name is Ming. I'm a financial analyst and trainer in uSMART, and I'm a full-time trader for past 7 years, and I mastered in stock trading, forex trading, crypto trading, and also automated trading strategies such as grid trading. So here I will focus on beginners trading guides. Today I will talk about long-term investing. So how can we become profitable in long-term investing? So for long-term investing, it actually, if you invest in this S&P 500 index, it actually can have a historical returns of average 7 to 10% per year, and it beats inflation over the time. Said to be heard that with simple investing in this S&P 500 ETF, you actually already beat many fund managers out there, because there are many private funds that cannot beat these results, that can consistently get 7 to 10% over the years in long run. So the studies by Dalba already show that the long-term investors typically outperform the market traders. It means that invest actually is more profitable than traders. If you keep trading the markets, because trading actually requires a lot of skills and understandings about the markets. So in trading, actually you can lose a lot of capital. However, by investing, actually you are consistently accumulate the funds in the long run, and if the market keeps going up, you actually become a very profitable investor. And it has a higher win rate is because it's due to the lower transaction cost, and also reduce in the emotions bias. So what happens if we active trading instead of long-term investing? Studies show that 80 to 90% of the traders lose money. So only about 10% consistently profits over time. So do you all trade yourself, or do you all invest? So if you know how to trade, then you will surely know what I am saying. Because if trading is really that profitable, then we can see a lot of traders outside there. However, trading actually is not that easy, and it's actually the hardest way to earn easiest money. People tend to think that in markets, the money is very easy by trading. Like if you see watch internet, there's a lot of gurus, watch a lot of social media. They are saying that trading is very easy, and you can earn a lot of money in short term periods. However, the reality is it's not true, because only I think less than 5% people succeed in trading only. Most of the gurus or CFOs we see in the internet actually earn more profits in the education. So here actually there's a statistic show that only 1% of traders were profitable after 5 years of active trading. Sometimes if you trade, you can get a winning streak. However, trading is actually a marathon. You cannot only succeed in short-term period of time. if you elongate the time over the you put the time like over 5 years, just 1% of people actually succeed. So it's not impossible to become a successful trader, but actually it's not as easy as it seems. And so here today my purpose is to share with you all how to long-term investing, as investing actually has a higher winning rate, and it's also suitable for those with low capitals and working employees. Here we will talk about why long-term investing wins more often. So investing has higher win rates, around 60 to 80%, due to patience, compounding, and market resilience over time. What it means by patience? It means that today if you buy a stock, the stocks move down or trend down, and you are on unrealized profits, you can actually you got a better emotions control. However, if you are trading, you actually need to set a cut-off to control your risk, because you are aiming for a short-term one. Usually trading is just for a short-term price action, and if the short-term price action went against you, you need to cut loss. Sometimes we can face losing streaks and our capitals can be gone very easily. It's because if we continue to lose a lot, sometimes we happen to face revenge trading. We will increase our margin and to trade with the lower capitals. And in the long run, we will keep on losing our capitals. However, by investing, you actually keep accumulate your stocks, and then over the long time, you can get a big amount of stock, and if the market goes up, you will eventually become profitable. And if you do long-term investing, you can take the dividends, keep on reinvest into the market, and then at the same time, it can significantly compound your capitals to become bigger amount over the time. And for the market resilience over time, it's because you don't time the market by investing. Trading is hard is because we need to time the market. Sometimes the market price will drop first before it went up, or went up, drops back, then went up. And a lot of price action happen. However, if the end journey, your target is up there, then you just continue to buy up. I will give more examples on why and how we do a long-term profitable investing at almost the end of the slides. So trading typically have a lower winning rate, and it's around 10% to 20%. In fact, what I see, I think around maybe around me, actually I think less than 5% that really succeed in trading. And you need to monitor a lot of stuff, like recent news, the fundamentals, the macroeconomy, the price actions, and a lot of things that can affect your emotions. So in trading, you actually need a very sharp, clear mind, and you need to backtest a lot, and you need to understand the market cycles a lot to become profitable. So it's not that beginner's friendly. So today here I will talk about long-term investing, which is more beginner friendly, and for those who don't have much capital, and how can we compound our profits and increase our capitals over the time. Alright? So I will share with you all I think a little bit about compounding, since we talked about compounding. So sorry, So, this I will explain a bit about compounding. For initial capitals, if we start with 1,000, like let's say, like per year the dividends can be 3%. Sorry. So let's start if we start with investment initial capitals like 1,000, and our daily compound is our yearly compound is 3%. So after 5 years, the 1,000 will become 1,135, which is around 33.77%, right? So, but however, if we constantly invest, like every year we invest 1,000. So after 5 years, and the yearly compound will be 3%. So after 5 years, we can get around 5,468.41, which is around, I think, 9% plus. Then over the time, if you every year invest 1,000, then at the end you will get 18%. Then as the time go over time, you can actually benefit from that. Oh, sorry. I think there's some technical problems here, so never mind, I will go back to the okay. So for long-term investing, actually we are looking for the compounding returns, and it can reduce our stress from daily market volatility, because we don't have to watch at the keep monitor the market. So we can have stress-free, and if we overwhelmed by the emotions, we can actually make many stupid mistakes in the market. Like when the market price drops a lot, we tend to sell at the low, and then when it goes up, we tend to buy high at the market. Then we keep chasing high, sell low. In the end, we will lose our capitals over time. So the ideology of investing, long-term investing, is keep buying and keep accumulate the stocks over time. Then you can enjoy the uptrend of profits. You don't need to time the market. You don't need to guess when the market will go up. You don't need to guess when the market will go down. You just accumulate it over the time. So usually, how do we pick a good stock in long-term investing? We usually pick stocks and also ETF because it has higher returns compared to other asset classes. And we usually pick those stable stocks that has given dividends and a potential of capital appreciation. So the companies will give dividends when it earns profits, and also give capital appreciation. And also the share price can go up over time. So here I will share with you all why dividend stocks is very appealing for long-term investing people. It's because when you bought a dividend stock at $1, let's say and the stocks give you 2% of dividend share, means 0.02 cents per share. Then how can we benefit from it over the time? So you bought the stocks at $1 and the stock gives you 2%, which is 0.02 dividend per share. Then as the time goes, if the stocks had a capital appreciation of $1, which is $1 to $2, 100%, right? Here you get a 100% capital appreciation, and by that time the dividend per share will be adjusted. If the company is giving 2% of dividends, then when the company hits $2, it gives 0.04 dividend per share, right? So here, how much we earn? So if you are looking for like dividend growth investment, here you can see that you bought at $1 and the $1 hit $2. So here you already get a 100% return of capital appreciation. Then initially you are getting 0.02 dividend per share with $1. So since your base value is $1 and after it hit $2, the dividend per share is 0.04, which is 0.04 divided by initial base stock price, which is $1, then you get a 4% dividend yield. Imagine if you bought at $1, like maybe 100k, and then 1 year you get 2k of dividends. Then when it hit $2, your 100k became 200k, and every year you can get 4,000 dividends. It's different that if you bought at $2 because the dividend per share is the same. However, if your stock price, your initial stock price is very low, over the time when the dividend per share is increasing and the capital is increasing, you actually can get higher return of the dividends. So this is why dividend investment is very attractive for some long-term investors. They will keep on get the dividend either for their passive income, or either they take the profits and then put it back and to reinvest. Right? So until here, I hope you all understand why long-term investing actually can be very, very profitable. Imagine you bought a bank stock, maybe you bought at $1 like during maybe COVID crash, or maybe some significant events. You know that this stock is very good, then you bought it, and the dividend at that time maybe is 0.02%, but when it hit $2, it can become, the dividend per share is also the same, 0.04. However, your base price is $1, so 0.04 divided by $1 is 4%. So you get a 4% dividend yield, which with only 100,000, you get 4,000. So initially you bought with $100 and the 2% dividend yield is 2,000. So what if the stock price increased to $3 with the 2% dividend policy? $3 is 0.06 dividend per share, and you bought it at $1. It can be 6,000 dividend for that year. So if you all get this idea of dividend increments, so this is why dividend investment is very attractive for those who want to buy, have a good capital gain, at the same time a good dividend. So next, I will talk about the principles of long-term investing. So the idea of long-term investing is to start early, because we need time to compound our profits. We take the dividends and then we reinvest. So at the same time, maybe every month we invest a fixed amount or a flexible amount. I will share with you all the strategies on how to do long-term investing. And for the long-term investing, we don't put all eggs in one basket. We diversify into some stable sectors. And then the most important one is be patient. In trading or investing, we actually need a good control and discipline. We need a good control of our emotions, and also we need to become very disciplined. Like when we bought a stock, if we aim the plan is for the long term, we need to stick to it. Long term is long term. Alright? So we can't diversify it. We can't like, okay, I want to buy this long term. Then when the stocks goes up, you want to become short term because you want to take profit. Then it goes up a lot more. Then you say, why I sell? Or it drops back. Then you start to think that why you drop. When it drops, you cut. You didn't add into it. So you need to have a really strong plan and you stick to it. Either in trading, either in short-term investing, either in short-term trading, short-term, long-term trading, all you need is a plan. Because when you execute your orders, you buy or you execute your orders, you can't do anything already. You need to plan ahead before you do any investment or trading. So our plan is very, very important. And I hope you all, if you all want to do a long-term investing, you have to stick to it. Then, if you want to compound, you want to have a faster capital appreciation, it's advised that you all reinvest the dividends into the markets. And stay consistent, stay disciplined, don't do any stupid mistakes like cut or didn't invest. Like if you plan to invest how much, like certain amount monthly, you have to commit to it, because all this is, you must treat all this like an investment. It's like a business. You need to like really stick to your plan, your strategic plan. All right. So for tools for research for our long-term stock, you all can consider to look into Yahoo Finance, Morningstar or Bloomberg. And you all can look into the annual reports and fundamental analysis. So I know many of you all like not really know how to do a fundamental analysis and not really know how to read annual reports. So now actually we can like use ChatGPT to do a summary for us. Or for me, I also not a fan of fundamental analysis, but I will still look at a basics one, like how much it earns, is it profitable, how is the cash flow of the company, right? This is the basic one. Then for the stock pick, I will only look into the top 1 quality stocks with strong economic mode business. So it's very easy to choose this. You just pick S&P 500 or Magnificent 7 stocks, which is like Google, Microsoft, Apple. For me, Tesla, I won't be considered it as a good quality stock, but it's very famous because I see Tesla as a business that is not consistent profitable. So let's say what is strong economic modes. We need to find a business that almost monopoly the market. So what we can see is like maybe Microsoft, Google, Adobe, yes, Adobe, and then maybe Amazon is very big, doing the cloud sector, and to name a few. So if you don't want to do so much analysis for individual stocks, we can look into the index ETF. Means S&P 500. What is S&P 500? It means the 500 top quality stocks in the US market. So the 500 is the top, like the 500 company is not doing well, they will exchange it with a better 500 company. Alright, So you don't have to pick the individual stocks, because sometimes if we pick the individual stocks, it can like went wrong. So if we pick the index, we can diversify it. So the risk is diversified. Alright? And we need to avoid the cyclical sector. What is cyclical sector? Cyclical sector is like sometimes this season they can earn a lot, and sometimes that next season they can lose a lot. Alright? So cyclical stocks is like commodities, like metals, like maybe palm oil, chemicals or health, like sometimes last time COVID. So we need a more stable one, which is like got a very strong economy. So next we need to determine the current market cycles, which is macroeconomic. So usually we need to buy. Usually we need to look at the macroeconomy, which is now what is the phase of the Fed interest. Usually we look at the Fed interest, like what is the Fed want to cut rate or increase the rate. It really depends on your strategy and which sector benefits the most. So usually it's very easy if you don't want to do analysis, you just pick the ETF like S&P 500 or Nasdaq, the index, and you just invest in it, and it will solve all the problems. Alright? Sorry. Okay. So, common mistakes to avoid. So in long-term investing, so we try to avoid chasing the trends, and we try not to over trading, and then we try not to ignoring diversification. We don't only invest in one stock, we can invest in one stock while at the same time we invest in the ETF index, because over the long run it's designed to go up. Like I said, the S&P 500 is the 500 top strongest company in US. It will keep on changing, swapping those top 500 companies. So only the 500 top companies will keep on remain over the time, and along with the inflation, the money value is become very less, so the value of the market will become very big. Like S&P last time is maybe less than 1,000, 2,000, now it's already 6,000, because the money is depreciate over the time because of inflation, and the value will become bigger and bigger and bigger. This is the facts. So like COVID, during the big crash, you just need to have faith to keep on buying at low, keep on buying until you become profitable, because you are investing in a good stock. However, it's the different story if you invest in a bad stock, like the stocks with hype. I'm not sure. We try to not chase the hype trend, which is maybe people say hype trend. We try to buy those that you have confidence to hold and add when there is the very big downfall of the market. Then we also need to like avoid emotional investing. We don't simply like when chase high a lot, we just put all our capital into it. When it drops a lot, we cut at low, and then if we do that, we will keep on repeat, buy high, sell low, buy high, sell low, buy high, sell low until we broke. So avoid doing these silly mistakes. Always remember, if you want to win the market, you have to win your psychology. You have to have a good patience in executing plan. You just plan ahead, and when you start buying, you just need to stick to your plan. What is your plan? When will you cut loss? When will you add? Is the company still alright? All this you have to do analysis beforehand. So next, this is the strategies that I recommend for everyone, especially for newbies or maybe experienced ones. I think one of your portfolio must have a long-term investing. You cannot say that trading is not good. You can trade at the same time, but you just diversify different kind of strategies. Like for me, I do dollar cost averaging. I do automated trading strategies which use bot trading like read trading, and I use option too. I use leverage tools like options. I also use CFD, and I trade different kinds and invest in different kinds of markets because the cycle is all different. So in terms of you want to get profitable over the long run, you have to diversify yourself, your portfolio, and maybe like invest looking at too many strategies can be very confusing. So for now, for beginners, I advise you all to start the simplest one, which is dollar cost averaging. Okay, what is dollar cost averaging? It's an investment strategy where you consistently invest a fixed amount of money at regular intervals regardless of market conditions. So anyone buy insurance? Alright, so do you all buy insurance? If you all buy insurance, your investment plan, they are actually using this dollar cost averaging. If you all remember that the insurance company like guarantee you how much returns over maybe 10 years time or 20 years time, actually they are using this method. I just share with you all their secrets. You invest a certain amount, fixed amount, constantly at a regular intervals. In this case, usually for insurance, is like monthly. You invest at monthly regardless of market conditions. Then there are bull markets, sideways markets, and also bear markets, right? So over the 10 years to 20 years investment plan by those insurance, you will buy until, if now is bear market, you keep on, since you are consistently buying at monthly basis, you eventually will become profit when you keep doing DCA, because you will DCA until the bull market comes. This is how, and usually the cycles will be around 10 years, and this is how the insurance plan or the bankers fund managers, the bankers fund plan did. And actually this we can, by doing this, we actually need to know this to choose the same portfolio with them, and we can manage it by ourselves. The downside of using this bankers plan or insurance plan is they get a commission. So like usually they keep 3% commission fee. Imagine if you invest 100,000, they already take the 3%. So you already lose 3% at the beginning when you didn't like earn anything yet. So the management fee is, for me, is not worth. And sometimes now got a lot of these platforms, they charge maybe still 1.5% commission fee. This is also absurd. We can do it ourselves. Just we don't have those knowledge only. They just simply keep on buying. Like if COVID happens, you keep on buying the S&P 500 or or Nasdaq. You keep on buying until now. Then you eventually become profit, right? So we need to practice this investment dollar cost averaging. I will explain why this is good for beginners and also for employees. We don't have much capital. So dollar cost averaging, we actually got two styles. One is fixed amount of averaging, and another one is flexible amount of averaging. Okay. So the fixed amount of, I will give you examples at the next slide. Okay, so this is gold and this is weekly chart. So every bar, Japanese bar is a weekly chart, and it's around 2021 to now, until now, the price. As you can see, it dropped during the COVID, I think around 30% from 2000 to around 1006, and then by the time it went up 2003 until now, I think it went up, I think almost 70%. So by doing dollar cost averaging, we actually keep on buying the same amount. Let's say you buy $100 every month. So this is week's candle. You just buy no matter what price is it. So if you just started to buy at 2001, and then you maybe bought at high 2000, then every month you just commit consistently 100, 100, 100, 100. As the time is getting long, if the accumulation period or the sideways period is very long, you just keep on averaging, because you just have $100 to buy every month. As the time goes very long, the price stay as a, you need to have a mindset that you want to accumulate a lot of, but you don't want to like all in at a specific pace, because when you all in at the wrong side, when it drops 30%, you can be very hurtful. So if you invest like 100, 100, 100 every month, so as the time goes over a long time, you get an average of the price, and then it started to make new highs, right? If you keep on buying every month, you cannot time the market. You did not time the market. You cannot time the bottom. But over the time, you can. If now the gold is getting new high, all your positions bought over the years at low, you eventually become profit. And because the time stay at low or sideways is very long, you actually get a chance to accumulate a lot more share over the time, because you only have $100 as a working employee over time. You every month just got 100 to buy. You just buy every month 100 buy and 100 buy. So like 10 months you get 1,000, maybe 100 months you get 10,000, right? So now the price keep on going up. Eventually, all your positions bought, you'll become profit. So this is the simplest way. However, if you do trading, you will keep on maybe buy high, sell low, because you are timing the market, and timing the market is very hard. So it keeps on repeat. Instead of accumulate the share, if you keep on trading, your capital becomes small and small, and then you tend to go revenge trading, over trading. Then eventually you will lose a lot. So just long-term investing is simple, and I show you the chart. But we also need to choose a good asset, like blue chips, like a good, like gold. Over the time, it had already proven gold is a safe haven asset. So you just bought it on it. You just buy it every month or every week, depends on you. You just buy it in the fixed amount, and then your time frame will be like maybe 3 to 5 years, 5 to 10 years. It depends. Like for S&P 500, some people like hold for, I think, keep on buying, I think 10 years or 20 years, right? So next, it is the same for Nasdaq. For Nasdaq, if you do a dollar cost averaging, you just keep on buying. You buy, even though there's drop of 38%, at the time we look back, we know it dropped 38%, but we cannot time the market when it dropped, because sometimes it dropped a little bit, then it went up. So we just keep on buying every month, do a dollar cost averaging until the time hits. Then when it make a new high, then eventually all your positions bought, it will become profit, right? You just face an unrealized loss if you keep on buying. Then for Bitcoin, it's the same. Bitcoin it's a blue chips of the cryptocurrency, so it's a little bit more speculative. But however, if you do dollar cost averaging, actually you can see that even though you buy at 60,000, when it drops, you keep on buying every month, keep on buying, until now it hits 90. I think today it hits 100,000, over 100,000. So all the positions you bought actually become all still profit. That time when you buy, it drops a lot. Many people want to cut loss already, but you just invest $100 like per month. So over the long time, you accumulate a lot of Bitcoin. You just focus on accumulate a lot of good shares. You have the mindset like this, and you believe this market, these sectors will perform in the next few years in long term. So you just buy. You cannot time the market because sometimes you feel that it will drop like maybe another 50%, then it went up all the way. Then you will miss the market. So by not missing the market, actually you need to like constantly involved in the market. And this is how easy you make money in the market. So I want to explain the difference between the fixed amount and also flexible amount. The fixed amount is you keep on buying, let's say you keep on buying 100 per month. You keep on adding 100, regardless the price of the market. You keep on buy. Then when the market goes up a lot now, like now you actually profit, right? Because all the positions you bought already in profit. However, if you feel that the market is very bad or it's very high already, you cannot like buy 100, then I advise that you can separate your money. Like let's say you want to invest $100, now you just start to invest $50. Then if it drops more, like maybe $5,000 of Bitcoin, like 100,000 to 95,000, you buy $60 per month. Then it drops another 5,000 range, you bought like $70. Yeah, then it drops like another 50,000, 5,000, you bought another, you invest more positions. You just separate it 100 to like start up with 50. If you feel very hard, then you keep on, as it goes up, you just keep on buying 50. Then when it goes down into a certain range, you buy 60 every month. Then when it drop more again, you buy 70 every month. Drop more again, 80. Then this is how you position yourself. However, if you time like this, sometimes you can miss a lot because it can keep on going up, right? So it depends on you. So for me, you can consider open two strategies. Like one, you just buy $100 every month, and another one, if you feel now it's very high, you just cut it to $50 per month, and then withdraw more. You eventually increase your amount every month. So this is how we beat the market. Actually, it's not that hard. You just need to focus the plan, and you need to commit it to the end. This is psychological problem, and many people actually can't do it, even though it's so easy. They tend to go gambling in the market. So this is different. If you listen until now, so I hope you all learn why we need to do long-term investing, because it takes time for us to accumulate wealth over the time, and many people can't do that because they want fast money. In the end, they lose more. It's simple as ABC, but less people do that. You can see in the top richest man, only Warren Buffett has a best. Only Warren Buffett is, I think, is the top richest in the board. However, you cannot see others trading fund. It is because the statistics already proven that investing over a long time in good company only is profitable. So Buffett will invest in S&P a lot, and like with over $100 billion, he keep on consistently beats the fund markets out there and beats the inflation. So you can ask yourself, or around people around you who bought the private funds, they eventually can outperform the S&P index. So sometimes investing is just simple as that, and many people can focus on it or focus the plan on it. And next is the Visa. We know that Visa has a strong economic mode, so we just buy it. So for the Visa, the long term, we always keep on going out because we know that the market has a strong economic mode. And for the dividends, you can see it also consistently give a good dividends. Then we can keep on reinvest, and over the time we can earn throughout the markets. And lastly, I will share with you all what is the timing which is very important on investing in the markets. So as you can see, so we need to determine that sometimes we need to know how to take some profits, and we need to determine that where is the market now. And here you can see the market cycles, market behavior, which is accumulation, markup, distribution, and markdown phase. So usually it will, like I give you examples of like maybe Nvidia. It usually take off without people noticing, then got a first sell out, and then it started to went up, has a media attention, and many people is very hype of it. Then eventually people become very greedy, and people will keep on like shouting, it will go higher and higher. So we need to determine which phase are we in now. And I won't share my view about this because this is very subjective also. So we need to keep on monitor about this, and then when it started to drop, on every rebound, those who chase high will keep on convince themselves that it will go higher. However, that's the time when shit happen, because it will keep on fall until many people trapped at the upside. Then suddenly the markets crash. This is the bubble cycle. Then the market crash, and many people it hit the capitulation stage. Usually the capitulation stage is almost the end of the downtrend, which is there is a very long bar, keep on dropping, and the market is full of fear, it's full of despair. Then the market starts to like sideways and return to mean, and the cycles for a good stock like Bitcoin, gold will restart again, like stock markets will restart again. The markets keep on repeat these market structures. This is the market behavior. But in the big time frame, short time frame, or even minutes time frame, hourly time frame, the market keeps on repeat this to wash all people. So the best one for not get washed out of the market is you keep on buying a good stock over the time. Then will be the time you will buy until the bull market reach, and then eventually you will earn profit. This is how easy long-term trading is. You just need to have a good patience and stick to your plan. So lastly, I just want to do a summary, like things you want to avoid in long-term investing. Emotional decisions making, and neglecting diversification, and we don't time the market, we just buy whatever we want every month consistently, and we overlooking the fees and the expenses. Sometimes we don't need to really look into the fees and expenses because we didn't trade right, our frequency is very low, so just ignore that. and we can't ignore the fundamental research. Sometimes if you buy an individual stock because it has a good fundamental, but sometimes the fundamental can change when there is something, maybe shareholders things happen or something bad happens, or like tariff sanctions, all those stuff. You need to avoid it, and then you stop chasing the short-term trends. Like we don't choose the hype trend, and we need getting rebalancing. Sometimes in the end of the year, we need to take some profits and then buy, like take a profit from a profit stocks, and then we buy another profitable long-term stocks to increase the rebalancing, to balance the stocks amount we hold. And we need to avoid over leveraging or using margins. So we need to avoid that. And yeah, I said in the markets we need to have a good control of our mind, and we need to stay out of lack of patience, and not staying informed. Like I said, sometimes the fundamental can be changed. Sometimes like US maybe lift tariffs or increase tariffs, all those stuff we need to know. But this is like a macroeconomic aspect, and if it can change the fundamental of this stock, you need to avoid it. However, to avoid all these problems, you just need to focus on invest in S&P index ETF. It's as simple as that. So for newbie or for those who really want to build wealth over the time, you all need to start to learn DCA. And we don't reacting to media, because when you see media is saying this market is good, usually this is the end of the market already. And if the media keeps saying this market is very bad or very bad about this stock, and then it has a good technical science or whatever, you must not believe media. Always not believe media. When you see media is saying this market is very bull, you need to be cautious already, because only minority will win the markets, and this is a hard truth. And I may not be a good presenter, but I am one full experience as a investor or trader. So for now, if you all think the market is getting very high, I think it still have more room until media start to say that the market is very good, all those, and you need to be careful by that time. This is my advice. I think the market still has the room to go. Alright, if you hear this, I think maybe you can get something, I think professional view you can't find out there. And this is the truth of the market, because market is a zero-sum place. Means you win other people's losses, you profit for other people's losses. So the majority will lose the money, and minority will earn the profits. This is how the market works, and many knowledge out there you found they didn't share about this. So this is my advice. If you all stay with me until now, so I'm very grateful. I hope you all learn something, and you all can use uSMART and press the trade and use the smart order and do this dollar cost averaging. And lastly, you all can consider to use my referral code for HK app. Will be the left side, the middle one will be the SG app, or consider to add me VCOM. And thanks for your, and any questions maybe you all can put it in the chat box. Alright, so I think there's no questions for you all. And then lastly, I got a Telegram group, but it's not that active. I hope people, maybe if you all can join, then we can discuss more about that in Telegram group. So if no questions, I will end my session here today. I hope you all learned something. So stay invested, stay patient and stay disciplined. See you all next time. Thanks for coming to my learning session.